Hello again, this is Andy with Seven Springs Wealth Group, here to bring you a couple of talking points for the fourth quarter and looking into 2024. So first, let's take a look at what's happened in markets this year to date. There are two primary assets classes, two big buckets that have worked very, very well this year. The first one is the 10 largest companies in the world that all happen to be in the US. You can see that here in the S&P 500. The other asset class that's worked very, very well is cash. You can see that here in this 4%. And really what this chart's showing you is that everything in the middle, whether it's small cap stocks, mid cap stocks, international equities, emerging equities, long-term bonds, high dividend stocks, real estate, all of that is either flat or down this year. So despite what you may think has happened in markets for 2023, there are two things that have really, really worked. The 10 largest companies in the world, a lot of that driven with the AI narrative, and cash. Everything else has been largely sideways as we've had a lot more volatility in markets, which is what, in interest rates, which is what this chart is showing. For the first time since 2007, we have the 10-year Treasury yield at 5%. In 2007, we had the iPhone debut. MySpace was the primary social media platform. You logged in on your computer. Harry Potter and the Order of the Phoenix was in theaters, and that person next to you on the highway may not have even been born the last time that we had 5% interest rates on the 10-year Treasury. Likewise, on corporate bonds that are now at 6%, besides the financial crisis itself, we haven't seen these types of yields in 20 years. What does that mean? That means looking in arrears. We've had a lot of volatility, in particular over the past several months, to get to this point. Looking ahead, we have some of the highest starting yields we've seen in 15 to 20 years. Equities, it's almost the inverse of what we just talked about for yields. So those yields are up. Equity price to earnings ratios are down as a result. And so small cap, mid cap stocks, you can see here, are trading very much near recessionary levels. And even in the international markets measured by EFI and emerging market economies, also at very, very compelling valuations here. Much cheaper than what we see in the global or the U.S. markets. So again, outside of those 10 largest names, which is largely reflected here in the S&P 500, we see those valuations have come down materially as we've had a lot of volatility this year and rates have risen. So let's put that all together in a chart here for valuation starting points. Warren Buffett reminds us that price is what you pay and value is what you get. So those 10 largest names are largely reflected here in the NASDAQ at that 4.2% yield. So the most expensive stocks are the ones that have the lowest next 12 months earnings to price yield. Going down the list, we have treasuries at 5%. That makes the S&P 500 around 5.7. And then here's where things really start to get interesting to me. Corporates, value stocks, international stocks, smaller cap companies, higher yielding bonds, all of these now with 6.5 to nearly 10% yields. These are very, very compelling starting points. A lot of these have been trading at almost double or half of this projected annual yield over the last couple of years. So as those earnings have continued to grow over the last couple of years, yet the prices of the assets have come down, you're now getting those same quality assets at much, much lower prices, which means better starting valuation points on a go-forward basis. So for our takeaways for all of this, we look at two different buckets, the short term and the long term. Over the short term, expect volatility to continue as we have these high rates and we see those daily drivers of market prices being the economy, earnings, a lot of geopolitical headwinds right now with 2 world wars going on. Plus, we have in the U.S., we have fiscal deficits that are ballooning. We also have some political gridlock taking place in an election next year. So we still see a lot of those same factors that we've been talking about all year long to be the daily drivers of what's happening in the markets. But over the long run, we do believe those valuations make for very compelling starting points for long-term investors. So we still believe that the historical compounding of returns can continue and we'll be able to climb the wall of short-term risks over longer periods of time. So if you're an investor that's been sitting in a lot of cash, this could be a time to start locking in some of these valuations that we haven't seen in a very, very long time, like we looked at in those corporate bond yields and those small cap yields and those value stock yields. And if you've been an investor and you've ridden the ride over the past couple of years and you've felt all that volatility and it feels like things maybe aren't working, we think this is a great time to hold tight and continue to stay as an investor. You own those same high quality investments that are now trading at better prices and valuations than they were before. So think about it as repurchasing those assets by merely holding on to them for the long run. If you have any questions about your portfolio or your allocation going into year end and looking into 2024, please don't hesitate to reach out to us. Otherwise, we thank you so much for watching, and we'll see you again here soon.